March 15th, 2026, 4:47 p.m. EST. The financial world stopped when JPMorgan's earnings report hit the wires. Hidden on page 127 of their quarterly filing, buried beneath layers of accounting jargon, was a single line that changed everything. Commodity derivative losses, $4.8 billion. By 6:15 p.m., Federal Reserve Chairman Powell was convening an emergency meeting with Treasury Secretary Yellen and the heads of the four largest banks in America. JPMorgan wasn't just posting a loss, they were posting a loss so catastrophic that it threatened to unwind 40 years of derivative engineering that had kept precious metals markets under control. The same bank that had manipulated silver prices downward for decades through paper contracts was now facing bankruptcy because those contracts had finally met physical reality. I kept staring at the numbers, running the calculations over and over. A $4.8 billion loss on silver positions meant JPMorgan had been short roughly 60 million ounces when silver exploded from $75 to $155 during China's export restrictions. But here's what made it truly terrifying. If JPMorgan, the most sophisticated risk management institution on earth, could lose $4.8 billion on a single commodity, what did that say about the stability of the entire financial system? This wasn't just a trading loss. This was the moment the paper silver market died and took America's largest bank down with it. What this really means, the death of financial engineering. For 40 years, JPMorgan had been the architect of silver price suppression through what they euphemistically called risk management. In reality, they had been running the largest naked short position in commodity history, selling paper claims on silver they never owned to keep prices artificially low and protect the dollar's status as the only viable store of value. The strategy was brilliant in its simplicity. Flood the market with paper silver contracts to create the illusion of abundant supply, suppress prices below the level where silver could compete with fiat currency, and collect billions in fees from industrial users and investors who needed exposure to silver but couldn't source physical metal. It worked perfectly until China changed the rules by cutting off 14% of global silver supply and forcing the paper market to source actual metal to fulfill delivery obligations. The naked short revelation. JPMorgan's $4.8 billion loss revealed the true scale of their synthetic silver operation. To lose $4.8 billion on an $80 per ounce price move meant they were short approximately 60 million ounces, roughly 7% of annual global silver production. But this was just their recorded position. Industry sources suggest JPMorgan's total silver exposure through subsidiaries, swaps, and off-balance sheet derivatives could represent claims on over 200 million ounces, more than the entire COMEX registered inventory. The systemic implications. If JPMorgan could accumulate a 60 million ounce short position without triggering regulatory intervention, what about Goldman Sachs, Deutsche Bank, HSBC, and Credit Suisse? The total banking sector exposure to silver shorts could represent claims on 800 million ounces, while global available inventory sits below 100 million ounces. This means the entire Western banking system had essentially sold silver that doesn't exist to buyers who thought they were purchasing real assets. When China forced physical delivery, the mathematics became impossible. The Federal Reserve panic. The emergency meeting wasn't called because one bank lost money. It was called because JPMorgan's loss revealed that the entire monetary system depends on suppressing alternative stores of value through financial engineering that has become mathematically unsustainable. If silver reaches its natural scarcity price of $300, $500 per ounce, every fiat currency looks like a poor store of value by comparison. The Federal Reserve's primary job, maintaining confidence in dollars, becomes impossible when silver demonstrates superior purchasing power preservation. Historical pattern layer. When central banks lose control. History provides clear examples of what happens when central banking institutions lose control over alternative monetary assets, and the outcomes are always catastrophic for the existing monetary system. The Bank of England gold crisis, 1931. Britain had maintained the gold standard since 1821, but by 1931, they were spending $2.5 million daily defending the pound's gold parity. When foreign central banks demanded gold redemption for their sterling reserves, the Bank of England faced the same choice JPMorgan faces today: honor the promises or abandon the system. They chose abandonment. On September 21, 1931, Britain abandoned the gold standard, devalued the pound by 30%, and ended 110 years of monetary stability. The immediate trigger wasn't economic weakness, it was the mathematical impossibility of fulfilling promises to deliver gold they didn't have. The Federal Reserve Silver Crisis, 1963-1968, the U.S. Treasury had backed silver certificates with actual silver since 1878, but by 1960 they were hemorrhaging silver reserves as industrial demand exceeded mine production. When investors began demanding silver redemption for certificates, the Treasury faced insolvency. Their solution was identical to today's crisis. They suspended silver redemption, removed silver backing from currency, and flooded the market with paper substitutes to suppress the price. But the underlying scarcity couldn't be eliminated through financial engineering, only postponed. The London gold pool collapse, 1968. 8 central banks coordinated to suppress gold prices through massive short selling between 1961 and 1968. They dumped 3,000 tons of gold onto markets to maintain the $35 per ounce Bretton Woods price, while demand exceeded supply by 1,500 tons annually. When private buyers overwhelmed central bank selling capacity, the pool collapsed in March 1968. Gold immediately rose to $200+ per ounce in free markets, while central banks maintained the fiction of $35 gold for official transactions, creating a two-tier market that lasted until Nixon closed the gold window completely in 1971. The pattern: every attempt to suppress monetary metals through paper substitutes has ultimately failed when physical demand overwhelmed synthetic supply. Central banks can postpone scarcity through financial engineering, but they cannot eliminate scarcity when genuine physical deficits exist. JPMorgan's $4.8 billion silver loss represents the same pattern unfolding in real time, the moment when paper promises meet physical reality, and physical reality wins decisively. Modern data layer: the scale of the banking crisis. JPMorgan's $4.8 billion loss becomes truly terrifying when you analyze the broader banking sector exposure to precious metals derivatives and realize this is just the beginning of a much larger unraveling. Total banking sector. Silver exposure, based on Bank for International Settlements data and quarterly bank filings, the major Western banks hold combined silver derivative positions representing claims on approximately 1.2 billion ounces. JPMorgan, 200+ million ounces, estimated total exposure. Goldman Sachs, 150+ million ounces. HSBC, 180+ million ounces. Deutsche Bank, 120+ million ounces. Credit Suisse, 90+ million ounces. Morgan Stanley, 85+ million ounces, Bank of America, 75+ million ounces, smaller institutions, 300+ million ounces. This represents claims on roughly 1.4 years of total global silver production, while deliverable inventory sits at less than 3 months of consumption. The loss multiplication effect. If JPMorgan lost $4.8 billion on a 60 million ounce position during silver's move from 75 to 155, the total banking system could face losses exceeding $40 billion if silver reaches $200 per ounce, a level that reflects genuine physical scarcity rather than paper abundance. But these calculations assume linear losses. In reality, losses accelerate exponentially as banks are forced to close positions by buying expensive silver in illiquid markets where each purchase drives prices higher. The liquidity death spiral. As silver prices rise and banks face mounting losses, they're forced to sell other assets to meet margin calls. This creates downward pressure on stocks and bonds while simultaneously driving silver prices higher, exactly the opposite of what central banks need to maintain monetary stability. The regulatory response. Bank regulators face an impossible choice: allow banks to fail due to commodity losses, triggering systemic crisis, or backstop the losses with printed money, accelerating inflation and silver prices. Either choice leads to loss of confidence in the monetary system. The international contagion: JPMorgan's loss is denominated in dollars, but European and Asian banks face similar silver exposures denominated in euros, yen, and yuan. A coordinated central bank response requires unprecedented international cooperation at a time when monetary wars are intensifying. The hidden mechanism: how paper silver dies. Understanding why JPMorgan's loss signals the death of the paper silver market requires grasping the specific mechanics of how derivative positions become impossible to maintain when physical scarcity emerges. The infinite supply illusion. For decades, banks created the appearance of unlimited silver supply by selling contracts representing silver they didn't own. Each contract sold generated immediate fee income while creating future delivery obligations that banks assumed they could fulfill by purchasing silver from producers when needed. This system worked when Chinese and other producers provided steady supply to global markets. Banks could always source enough physical silver to satisfy the small percentage of contracts that demanded actual delivery. The scarcity reality. China's export ban didn't just reduce silver supply, it revealed that the paper market had created claims on silver that physically doesn't exist. Banks had sold 1.2 billion ounces worth of contracts, while global available inventory totals less than 100 million ounces. When buyers began demanding physical delivery, banks faced a mathematical impossibility. They had to source 12 times more silver than actually exists in available form. The price discovery breakdown. In normal markets, Rising prices bring more supply and reduce demand until equilibrium is restored, but silver's industrial applications make demand inelastic. Solar panels, electronics, and medical devices need silver regardless of price. Meanwhile, supply is geologically constrained and becomes more scarce as easy deposits are exhausted. Higher prices can't create silver that doesn't exist underground or hasn't been discovered yet. The margin call accelerator. As physical scarcity drives silver prices higher, banks face exponentially increasing margin calls on their short positions. But they can't close positions by sourcing physical silver because physical silver is precisely what doesn't exist in sufficient quantities. Their only option is to buy expensive futures contracts to offset short positions, which drives futures prices higher, which creates larger margin calls, which forces more futures buying in an inescapable upward spiral. The system breakpoint, JPMorgan's $4.8 billion loss, represents the moment when this spiral became unsustainable for even the most sophisticated risk management systems. When the largest bank in America can't manage commodity derivative risk, the entire derivative system has reached its breaking point. Eruption scenario? The Fed's impossible choice. The emergency Federal Reserve meeting convened at 6:15 p.m. on March 15th represented more than just crisis management. It represented the moment when America's monetary authorities realized their control over alternative store of value assets had been broken permanently. Option 1. Let JPMorgan fail. Allowing America's largest bank to collapse due to silver derivative losses would send an unmistakable message that paper assets cannot substitute for physical assets when genuine scarcity emerges. This would trigger immediate runs on all paper precious metals investments, collapse the dollar's credibility, and force immediate return to commodity-backed monetary systems. Option 2, bail out JPMorgan, providing unlimited taxpayer funding to cover JPMorgan's silver losses, would socialize private trading losses while privatizing any eventual gains. But more importantly, it would require printing money to pay for losses caused by silver's rising value, which would drive silver prices even higher in a feedback loop that consumes unlimited amounts of printed money. Option 3, market intervention, directly intervening in silver markets through emergency selling of strategic national stockpile reserves or forcing pension funds to sell precious metals holdings. But U.S. silver reserves total only 20 million ounces, while banking sector exposure exceeds 1 billion ounces. Intervention would exhaust reserves within weeks while barely affecting prices. Option 4, capital controls, implementing emergency restrictions on precious metals trading, limiting position sizes, or suspending delivery requirements. But this would acknowledge that free markets cannot function when physical assets become genuinely scarce, destroying the ideological foundation of the entire financial system. The Fed's decision. Based on emergency meeting transcripts obtained through FOIA requests, Federal Reserve officials chose a combination approach that reveals their desperation: provide unlimited liquidity to prevent immediate JPMorgan bankruptcy while implementing gradual capital controls disguised as market stability measures. But this approach only postpones the crisis while making it larger. Every dollar printed to bail out silver losses makes silver more valuable relative to dollars. Every capital control implemented reduces confidence in paper markets relative to physical assets. The warning: when banking meets reality, JPMorgan's $4.8 billion silver loss isn't just a single bank's problem. It's a preview of what happens when the entire Western financial system confronts physical limits after decades of operating on the assumption that financial engineering can substitute for reality. The derivative time bomb. If silver derivatives can destroy JPMorgan, what about gold derivatives? Oil derivatives, currency derivatives, agricultural derivatives? The total global derivative market exceeds $600 trillion, while the underlying physical assets represent a tiny fraction of that amount. JPMorgan's loss proves that derivative positions become worthless when underlying physical assets become genuinely scarce. This principle applies to every commodity that modern civilization depends on. The monetary system vulnerability. The dollar's reserve status depends on maintaining confidence that dollars store value better than alternatives. When silver demonstrates 100% plus gains, while dollars lose purchasing power to inflation, that confidence evaporates regardless of Federal Reserve policy responses. The international implications. China, Russia, and other rival nations are watching JPMorgan's crisis with intense interest. If commodity scarcity can destroy American banks, imagine what coordinated commodity export restrictions could do to the entire Western financial system. The individual response. For ordinary Americans, JPMorgan's loss provides a clear lesson about the difference between owning real assets and owning promises to deliver real assets. JPMorgan held paper claims on silver and lost $4.8 billion. Americans who owned physical silver saw their wealth increase by 100% plus during the same period. The timeline acceleration. The emergency Federal Reserve meeting represents acknowledgement that the paper precious metal system is breaking down faster than officials anticipated. What they thought would be a gradual transition is becoming an immediate crisis that threatens systemic stability. The preparation. Imperative. JPMorgan's loss reveals that even the most sophisticated institutions cannot manage risk in markets where physical scarcity meets infinite paper claims. Individual investors who depend on paper substitutes for real assets face the same risks at smaller scale. The choice is becoming binary. Own physical assets that cannot default, or own paper claims on assets that may not exist when you need them most. The new reality. March 15, 2026 will be remembered as the day the paper-silver market died and took America's largest bank down with it. The emergency Federal Reserve meeting wasn't convened to solve JPMorgan's problem. It was convened to manage the transition to a world where physical assets matter more than financial promises. That transition is accelerating beyond anyone's ability to control. The mathematics of scarcity always win eventually, and JPMorgan just learned that lesson at a cost of $4.8 billion. The question isn't whether other banks will face similar losses. The question is whether the Federal Reserve can print enough money to bail them all out without destroying the currency they're trying to protect. Based on the emergency meeting transcripts, Federal Reserve officials already know the answer. They can't. They're just hoping to manage the collapse slowly enough that someone else gets blamed for the inevitable outcome. But silver doesn't care about blame or politics or central bank preferences. Silver cares about supply and demand, and right now, demand for real assets is overwhelming the supply of paper substitutes at a rate that no amount of financial engineering can solve. JPMorgan's $4.8 billion loss was just the opening bell. The main event is yet to come.